On behalf of Crosscheck Media and BizTalk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger, and joining me today is Ross Mayfield. He is the investment strategist at Baird Private Wealth Management. Ross, welcome to the program and Happy New Year. I want to start off by saying you are coming to us as a macro expert, a macro specialist. So in your opinion, what is the one macro narrative that you think the market is getting most wrong right now?
Yeah, well, first of all, thanks for having me. Happy New Year to you as well. I don't know if it's entirely consensus or not yet, but we spent a lot of 2025, wrestling with the question of whether we're in a tech bubble, hearing all about the corollaries to the late 90s and the dot-com bubble. And my pretty strongly held take is that this is not a bubble and not really even close. I can see the comparison points, obviously the new technology at the center of each, but the price action and the sentiment just aren't there yet. The blow off top in the late 90s was something to behold. Right now, we have a robust bull market to be sure. But if you look at what the NASDAQ did from late 98 through early 2000, it dwarfs any kind of price move we've seen in this current bull market. And then sentiment, it's starting to get a little frothy. It's probably the main thing that I want to watch in 2026. But every 3, 4 months, we heap a new level of skepticism on the AI spending, the AI theme, the capex from some of these big tech companies. I just don't get the sense that that level of skepticism is reflective of a bubble where every bear throws in the towel. So I don't think we're there yet. The fundamentals still look solid. There are corners of the market that bear, watching and maybe are in bubbles themselves. But by and large, I think the broad market is not in a bubble, not really close. And I think that the comparison to the late 90s misses a couple really key points.
Yeah, that's some good points. And you're right about AI. It was the dominating theme, obviously, last year. It should continue this year. But coming up this week, though, you have a jobs report that's rolling out on Friday. And this is going to be considered the real jobs number. We haven't had one for a few months because of the government shutdown. With the number, the expectation is five digits right now. That's sort of irrelevant, but what do you think markets are going to take from this? Because you also have a pivotal Fed meeting coming up at the end of the month, which has been helping drive equities higher. Do you see that continuing in 2026? Or do you think that markets might just be looking at the Fed rate cut cycle as just something on the back burner for now on?
No, I think it's a big part of the package of catalysts to keep the bull market going is the anticipation and the pricing in of continued Fed easing, and entirely because of the labor market weakness, right? And I think this jobs report, I agree with you that the headline number is fairly irrelevant. We got an ADP print already that was fairly weak, but it's all confirmation of what we already know from the past 6, 7, 8 months, which is this is not 2022 and 2023's job market. This is a cooling labor market. Companies may be, hesitant to fire or lay off in mass, but they are not hiring. We are not adding new jobs. Now, maybe the break-even number has gone way down because there's no immigration right now. But irregardless, I expect a pretty soft number, continued weakness in the labor market that will spur more Fed rate cuts that the market is asking for. So I think January is probably a pause month, but then I think we get back to that March meeting and see more rate cuts, at least until we get to what the Fed views as a neutral rate. We talk a lot about rate cuts and how the Fed is easing, even with inflation north of 2%. But they have a couple more cuts just till they get to their neutral point. I think they want to do that with haste and then, maybe take stock of the landscape from there. But the labor market demands more rate cuts, in my opinion.
Interesting. So we had such a rising market last year. I mean, Nasdaq up 20%, S&P up close to 17%. Going into this year, 2026, the theme is still somewhat positive, but also volatile. What are you telling Baird clients right now who go to the firm and they say, look, I missed the rally last year, but I think I'm going to be able to capture it this year? Do you see markets continuing that upward trajectory through 2026?
I do. I think there's a lot to like. I think this bull market has plenty of momentum, in the middle innings, the baton being passed from valuation expansion to profit growth, profit margin expansion. But I do think, and obviously we've seen, plenty of stretches over the last 100 years where we've had 4 up years in a row. Because if 2026 is to be positive, it will be the fourth year of gains after 23, 24, and 25. So I think there's plenty of opportunity for investors to still get into this bull market, participate in gains, especially as we, maybe look outside of big tech and look, international or down into small caps or some areas of the market that haven't run quite as aggressively. The one thing I will say is, 25 or 26% in 2023, 25% in 2024, 18% last year. We need to temper our expectations, right? We expect the market will largely track profit growth this year because it is still pretty expensive. Maybe that's 8, 9, 10%, right? And that's a great year, but it's not the blowout returns that we maybe have gotten accustomed to over the last couple of years in this bull market. So I think it's you temper your expectations, but I don't think there's a lot not to like about the market right now. And I think ultimately at the end of the year, we'll look back and have had another good year in stocks, but maybe an opportunity to look outside of the Mag 7 and just the big tech conglomerate that's been driving things higher lately.
Right. So I want to get your opinion on something. A number of experts come on these shows that we air on BTT, and they like to say, oh, the stock market's been up, like you said, double digits for the past 3 years. And, just because of that, just because markets should start sliding. What's your opinion there? Do you think that that's a real warranted reason to maybe start being more cautious going forward? Because I'm not of the belief that I just think it doesn't really matter what has happened in the past. It only matters what happens in the future. But do you think that maybe the bull market could just be a little long on the tooth right now, or what's your thoughts?
Yeah, look, we're in year, for this bull market. If it were to end tomorrow, it would be, historically short for bull markets that have made it to their second year. So this is to me not a bull market that's long in the tooth. It is a market that looks pretty expensive any way you slice it. So to the extent that, past gains have been built on valuation expansion, that can't continue into perpetuity, right? Those sorts of trees don't grow to the sky. The good news is, again, profit growth, earnings growth, sales growth, that kind of can step in. It did in 2025, and expectations are for 2026. But I tend to agree with you. I mean, two quick points. I mean, number one, if you look back over the last 100 or so years, roughly a third of the time the market has been up 3 years in a row and then has gone on to be up a fourth year,
Hmm.
with a median return of in the teens of like 15%. So past returns are not a reason to get bearish, in my opinion. And then on the flip side, the argument that, strength means that things have to get bad in the future is runs counter to what we know about markets, which is that they trend, that momentum matters a lot in markets. And so when you have strong trends in markets, and we're in a strong bull market right now, and you have momentum pointing up and to the right, you want to ride that wave until you start to get signs that the bull market is deteriorating. When things start to get really narrow, as they did very late in the dot-com boom, right now we're seeing the opposite. We're seeing the market broaden out while tech takes a breather. Financials, industrials, discretionary starting to work. So I think you maybe temper expectations again, but I don't think that past gains are reason to be bearish in the future. And in fact, if you're going to pick one side of the coin, it's in my opinion a reason to remain bullish because momentum tends to persist in markets.
Yeah, brilliant point. So you mentioned small caps earlier. What are your thoughts on the small cap side? We had last year the expectation that small caps would break out because of the Fed easing cycle. Do you see a rebound in small caps this year, or still more of that focus on the AI side?
This is the trickiest one, and I kind of waffle, to be quite frank with you. I do think that there is a structural headwind to small caps in the form of a higher for longer rate environment. And we talked about the Fed cutting. We expect the Fed to keep cutting. But I think one, there's a floor on where the Fed will be able to cut because of the inflation backdrop, right? They might cut down to neutral, maybe dip a little bit below it, but they're not going to pull rates to 0% like the 2010s
Right.
because of that inflation backdrop. Just a totally different world than we saw in, 2013 or 2014, when the Fed had rates at zero. And then on the long end of the curve, you have fiscal issues, you have, the national debt, the budget deficit, you have, structural pressures that keep the long end of the curve a little bit sticky. So I think if you look at the yield curve from short end to long end, you have a stickiness. And we know that small caps are much more rate sensitive than large caps. They have a lot more floating rate debt. They're a much more cyclical group in the first place, a lot of regional banks. So I think they can work. I think there are pockets where small caps can outperform, but you need to be an investor that's willing to get tactical with small caps. I think if you're just kind of a set it and forget it investor, large caps are still the place to be. I think small caps face a couple of really difficult kind of structural headwinds to overcome if you're looking at 3, 5 year time horizons. So I think you can make money in small caps. I think the bar is still pretty high to do so.
With the events that took place over the weekend in Venezuela, the oil investment right now, I mean, oil seems to be front and center. When clients go to Baird, what is the opinion? Is now a good time to start considering oil, or would you just wait and see how everything plays out?
Yeah, so with the geopolitical events, I mean, two points. Number one is we tend to talk to our clients about, generally the US market in particular can look through geopolitical events, especially if they happen, far afield of American soil. And typically the ones that have impacted US markets or the US consumer pocketbook are the ones that make oil prices and therefore gas prices go a lot higher. So you can think about 1973 oil embargo. You can think about 2022 Russia invades Ukraine. In this case, the result might be more oil on the market, right? If some of that Venezuelan crude starts to hit global markets, we're already in an oversupplied position. Oil prices are hovering around post-COVID lows. So from a consumer perspective, it tends to be a good thing. Low gas prices, stimulate the economy, that sort of thing. As an investment, I do think there's a place for commodities and real assets. But if you look at the landscape of all of them, precious metals and industrial metals look much, much better than oil and some of the energy
Hmm.
names. The oil chart looks pretty brutal right now. I think again, it's if you want to be tactical, sentiment is really dire in oil, so there's opportunities to for reversals on that front. But the chart looks pretty broken. Everything that we read is that the market is oversupplied in the first place, and if we get more Venezuelan crude, it only adds to that problem. So I wouldn't be recommending it as an investment, but as from the broader macro landscape, lower oil prices tend to have more tailwinds for U.S. investors than headwinds. Just not a direct investment for us right now.
Okay, that makes a lot of sense to me. So you brought up precious metals. I got to ask you, we saw such a run up in gold, silver, copper last year. What are you telling investors these days? I mean, is it going to continue in 2026?
I think probably not to the extent we've seen. That's not a bold call to say that we're not going to see another 60, 70% year in gold back to
Right.
back. I do think that what we've seen does make the argument for, gold, precious metals, and real assets in general as a more significant part of a diversified portfolio, right? This is becoming a more deglobalized world, a higher debt world. There are a lot of competing forces, and I think that precious metals are going to play a role in diversified portfolios. With that said, we don't view non-cash flow earning assets as growth drivers of a portfolio. So, I talk to clients all the time who love gold. I'm not going to tell them not to love gold, but I think about it more as kind of a hedge for geopolitical events, for dollar uncertainty, and less as a driver of returns. We still want to look to equities, to stocks with cash flows and earnings for that, and hold maybe a smaller portion in precious metals and real assets as something that can be a diversifier, something that can be a crisis hedge or a black swan hedge, something that works in environments where stocks and bonds might struggle. Last year, where everything went up at the same time, bond stocks, precious metals is a real historical outlier that we probably won't see repeat too many times in the near future.
Yeah, definitely historical, that's for sure. So final question for you. With the expectation that rates will continue to drop in 2026 from further Fed rate cuts, what are your thoughts on real estate? Is this a sector, because it's been a dying sector for the past few years, is this an area that Baird investors might want to consider?
I think you can. I think that's another place where I want to be really tactical because, you look inside of real estate and you can tell two entirely different stories about office real estate versus multifamily or leisure and development, some of or leisure and recreation, some of the hotel type REITs. So there are very different stories even within the real estate landscape. Office REITs have really struggled. We know the return to office story. We know the geographical diversity. We've seen some of these issues in regional bank balance sheets. On the flip side, hotels and travel have been a real beneficiary of the post-COVID boom. So I think rates coming down in general, good for real estate, but that is an area where, unlike some where I think you can, maybe buy an ETF or a fund to kind of set it and forget it, I think you want to be a little more tactical in real estate. And again, like small caps, I think even if we see Fed rate cuts, I do think we're in a more kind of normalized pre-great financial crisis rate environment where higher for longer backdrop just raises the bar for what these types of companies have to do to outperform. And so I think you want to stick with high quality operators, move up in credit quality and asset quality, and maybe take your lumps if there's a junk rally. But you need to be a little more tactical in that sector, and I think that's going to be the case for the foreseeable future.
That's great. Tactical it is. I love it. And I could see investors taking advantage of that strategy this year. So, Ross, thank you. This was fantastic. A wonderful conversation. I hope to have you back later on this year to talk further about the markets and where we're headed on the macro cycle.
Thank you so much for having me. I'll be back anytime. Just let me know.
Absolutely. So on behalf of Ross Mayfield, I am Todd Schoenberger. Thank you once again for joining us on the Money Path. We'll catch you next time. Take care.
Access real-time data and intelligent analytics exactly when you need them. Get the right data at the right time. Learn more at quotemedia.com.